this space, what we are seeing is persistently low bond yields as investors continue to look for safe haven assets. When we look at sovereign bond yields in the developed markets and corporate credit spreads, these yields and spreads are at all-time lows in our view. Essentially, investors are opting to buy yields that are very low and below inflation as a means of reducing perceived global market risk. This has been exacerbated by the fact that central banks globally have largely cut rates during 2019. So what this says to us is that investors in this market are assuming that yields persist at these low levels or continue to fall going forward, giving more price appreciation. From an income perspective, with these yields already at negative rates, investors are willing to give up future income as opposed to investing in emerging market bonds where yields are quite high and above inflation. It does seem to us then that valuation has been thrown away as a key consideration when investing in global bond markets. South African fixed income markets still presents a rare opportunity in a global context. So from a macro perspective, South Africa is still clouded by fears around our fiscal sustainability as well as sustainability of our energy sector. As we look forward to the next few months, it's largely expected that Moody's will cut our last investment rating to junk status. Starting the year with load shedding in South Africa, sentiment remains really poor and the low growth outlook remains a feature of our economy going forward. But when we focus on a fundamental basis, a key driver of fixed income returns in South Africa has always been inflation and your expectation of real returns. During 2019, inflation averaged around 4%, quite a low level and below the Reserve Bank's midpoint, and we expect that the Reserve Bank would likely try and keep inflation around these levels going forward. In this context, our fixed rate sovereign bonds are offering yields around 9 to 10%, and this means a real return or yield above inflation of close to 5%, with a fair amount of visibility of where inflation will be over the next few years. In addition, our inflation-linked bond market is offering real yields of 3 to 4%, which are quite attractive. These represent not only very attractive income yields for clients in these bonds, but given where bond yields are now, there's ample room for bond yields to fall going forward, offering price appreciation for investors. So going back to the fundamental basis, it does seem that a lot of the macro risks that we are seeing in South Africa are largely priced into yields. We remain fairly optimistic about the prospects of returns in our local fixed income market. If you look at the last few years, South African fixed rate bonds have delivered around 10% and well in excess of 10% returns for clients. And we think this is a likely outcome going forward for a few reasons. Bond yields generally reflect sentiment very quickly, and so the poor backdrop that we're seeing in South Africa now should be largely priced into yields. South Africa currently offers some of the highest real yields that we can see globally, and so this is attractive to both local and global investors. Inflation, which is a key driver of bond yields, has been persistently lower than market expectations, and we have already seen one interest rate cut this year, and this is very good for bonds. And then finally, we do not need bond yields to fall significantly from these levels, with the income yield that you're really earning close to 10%. At PSG, we continuously look for where the best risk-adjusted returns can be earned for clients. So when we look at the local fixed income market, corporate credit remains an area where we think levels are quite expensive and yields are not compensating for the risk of lending to these corporates. We therefore avoid lending into this area, with only selective opportunities being considered for our funds. And then in a global context, we are avoiding developed market bonds. And we've also become less attracted to longer dated money market instruments issued by South African banks as these yields have compressed over the last 2 years.